The case study of Bob and Jane YouTube. When can they retire? That's what we're going to talk about here. This is going to be a sample case that we'll use to kind of help you figure out your own situation and maybe some of the issues that you've been having up to this point about comprehensive financial planning and how maybe it's telling you a little bit differently about your own ability to retire. So let's dive right into this. We're going to use Bob and Jane YouTube. That's my go-to sample for folks. And let's just start with them and their profile. And so they came to me, they said, man, we saw your YouTube videos. It looks good. We just don't think we can retire. Our current financial advisor says no. All the models we run say no. And so maybe you can help us because we really want to retire because our crappy old jobs are killing us. All right, so in this case, we have Bob's 53, Bob's 55, and Jane's 53, okay? They have a net worth of $486,000, of which Bob's 401k is in the Vanguard Total Stock Index. He's got 235 in there, and Jane's got a 401k of 250,000 in the Vanguard Ginnie Mae. So basically 50-50 stock to bond mix because they're thinking, we're whatever. That's what the models tell them they should be, 50-50, because you take 100, subtract your age, and that's how much you should have in bonds. That's where they're going off, which is, okay, we're not here to judge on that, but that's where they are today. All right, so they also have a house that's paid for. All right, so they got a house at $400,000, completely paid for. Property tax at $3,000 a year, annual property insurance at $1,200 a year, and they live in Georgia. So right now, Tennessee. So there's no state income tax. Right now, we're just saying no state income tax for simplicity. All right, so that's where we're sitting on so far. All right, so now let's go to their expenses. Because they have no debt, they just spend $5,000 a month. That's it. All right. Now, they don't have any investment management fees. They don't have any outside IRA accounts. So the taxes and fees on their portfolio are nil. Again, it's $5,000 a month is their monthly expense. All right. So now we go to savings. This is what they put in too, by the way. I didn't put it in. They put it in. Now we're going to savings. All right. So they're both putting $10,000 a year into 401ks. All right. So they have. That's what they're trying to do. They're really trying to ramp up their 401k money to make sure they can not ever have to stay working until they're 70 years old. Bob's putting $10,000 a year in. His primary match is 8%. So he puts $10,000 a year in. They match 8% of his salary. And Jane's this exact same thing. She's putting $10,000 a year in. And their primary match is 8%. All right. So the first question that you'd want to know is, well, that's great, but what's their salary? All right. So their salary, Jane's salary is $20,000. All right, for his last year, $20,000. All right, so she's making half of that is going to the 401k, and 8% of her was $1,600 the company's matching. Now, don't get too caught up on these salaries because there's going to come an issue here to share with you just a second. Don't get too caught up. All right, Bob's salary is $80,000 a year. All right, and don't get too caught up on that either. I'm just telling you right now. He's making $8,000 a year, and again, he's putting $10,000 a year into his 401k with an 8% company match as well. So they're putting in $16,000, and he's putting in $10,000. So $26,000 going into his. Jane's got what 11,600. Their estimated Social Security, we're going to use a simple estimate, and they're going to take it at the full retirement age. And a simple estimate, again, bear with me. This is what Bob and Jane put in there. Bear with me. There's a method to my madness, my friends, so stick with me. All right, and Jane's Social Security, same thing. She's going to take Social Security at her full retirement age of 67 as well. All right, so that's the basic of it. Now, their goals are they want to retire in 5 years. So Bob wants to retire at 60. Jane wants to retire at 57. The retirement expenses are $5,000 a month. Okay, that's what they think. And now they told me, they said, Josh, we're just going to include everything on everything. So we're not going to have any long-term health care costs that could affect it. We're not going to consider that right now. We're not even going to include annual health care costs or retirement because we're going to assume that's all encompassing in the $5,000 a month. All right, so that's what they're putting in there. So you with me so far? So that's what they're modeling. They put all this in here. And so now I say, okay, that's great. So we go back to the dashboard. We look at their net worth. No debt, which is a huge thing. And their net worth consists of invested assets, roughly $500,000, real estate assets, $400,000, and a total net worth of $886,000. All right, with me so far. And then if we break it down, we see the joint account, the home is held jointly, And then Jane's got a little bit more in her 401k than Bob does. All right. And so, frankly, the first thing that jumps, and look, I get this like this all the time. And the first thing that jumps out is, if Jane's only making $20,000 a year, how come she has more in her 401k? Interesting. Because Bob's making 4 times a year than Jane. How come Bob has less? Interesting, huh? All right, so now just based on this alone, we're going to hit the retirement. And this is where we start running cash flow scenarios. And whoa, look at that. Only a 3% probability of success. That's not good, man. So a 3% probability of success where they retire in 5 years, and they're going to take $5,000 a year off their retirement accounts. Oh my goodness. Whoa. You guys can't retire because we're only getting a 3% probability of success. And if we go to the confidence, all right, so this is running all these Monte Carlo scenarios, hundreds and hundreds and hundreds. The mean is the dark blue in the middle, and their mean runs out of money at, that's age 73. So at age 73, 50% of the time they had less than $6,800. 50% of the time they had more than $6,800, but between the 25 and 75%, the most they have is $225. So under this current scenario, we're like, yikes, you should not retire. This is bad. And then we come up here, and at age 77, the mean is they have no money. And with the max of the 75th% confidence level, anything from 0 to 75% confidence, they have less than $40,000. Let's just put it that way. All right, so essentially, in the 95% confidence is they have about $556,000. So essentially, they run out of money. No one's going to sit there and say, man, you should retire under the synopsis that you shared with me. So you're going to have to keep working. No one should say that. All right, so everyone's going to say you should not retire at that age because you're going to run out of money. All right, are we with me so far? So the confidence level is very, very low about their ability to retire. And so then I say, what if we just change a couple things? What if we make Bob's retirement age 62? And Jane's retirement age of 59. Let's just do that. We hit refresh just to see what that looks like. And we go to probability, and the probability goes up a little bit, but not much. So Bob and Jane are just miserable. They're like, man, look at that. Only a 16% probability, even if I stay at work in another couple of years. And then we hit a probability. Let's just say Bob doesn't retire till his full retirement age, and Jane doesn't retire till she's 64 because she's 3 years behind Bob. Yeah. All right. So let's say they work another 12 years on top of what they're doing now, and it jumps up to 87%. But Bob's like, Bob's miserable. He's like, I don't know if I can do that. I don't know if I can stay working that long. That makes him very sad. All right. Because that's an extra 7 years of working a crappy old job. So I said, well, and then we go back here to 57 and we revisit a couple of things. All right. There's a lot going on here, my friends. This isn't good. So the first thing we want to do, the very first thing is we got to figure out our cash flow. All right, so now what we're going to do is we're going to go to retirement cash flows because remember, they said $5,000 a month is all encompassing for what their income needs are. All right, so they need $5,000 a month, all encompassing. So if we go down here to expenses, why do we got more than $5,000 a month? Because $5,000 a month is what they need today, and essentially a little bit more inflation with a 3% inflation is what they need when they retire in 4 years. But yet that doesn't look like $5,000 a month. That looks like more. So why? So let's see where the expenses are coming from. Oh, they included housing in terms of let me show you. They included in their profile their monthly or their annual property tax and homeowners insurance of $4,200 a year, property tax and homeowners insurance. So that means we can go back and reduce our expenses by $4,200 a year. So let me bust out my trusty calculator, which means we take 60,000 minus 4,200 and we divide that by 12. So our monthly expenses goes from 5,000 to 4,650. That's our pre-retirement expenses. So first and foremost, 4,650, crack house, save that. And then under goals, we're going to do the same thing, 4,650. We want to keep the separate line item as well for property taxes and homeowners expense, and homeowners insurance, because it's easier to look at because those expenses never go away. All right, so that's the first step we do here. All right, now what else do we have going on here? Because that just seems like, okay. And so let's take a look at retirement. And what we're going to do is we're going to see what other expenses, and that increased our plan by 200%, went from 3 to 9%. Interesting, isn't it? All right, so let's go to cash flows. And let's see what else we have here. So cash flows, okay, that's 5,000. We're inflated it by 3% a year. That's good. Pretty good taxes while we're working. Not so big when we retire. Then we see total inflows. That's going to be from required from Social Security. So Social Security starts kick. That's interesting. 3,000 a month from Social Security. That's for Bob. And then Jane's kicks in at 67 for her. And that's going to add another 20,000. So basically, Bob's is going to be 3,000 a month, and Jane's will be 20,000 a year divided by 12. So Jane's is only 1,666. Let's see how we get these numbers here. So we're going to look at the profile. And again, this is what Bob and Jane put in. We're going to look at income, and we're going to look at estimated Social Security. Oh, using simple estimates, this program will use the current salary and salary increase to estimate the future Social Security benefits. You can attain an estimated benefit at full retirement age from going to socialsecurity.com. So we're estimating based on their current salaries. And Jane's is 20,000. Remember that? Bob's is how much? Well, Bob's is 80,000. I wonder if that's legit. Jane's is 20, Bob's is 80. Interesting, is it not? So let's go to our trusty spreadsheet. I had Bob and Jane log into socialsecurity.gov, and actually this is not the real numbers for Bob and Jane. Isn't it ironic? So if we go to our trusty spreadsheet, which we just pulled off socialsecurity.gov, we actually take in Jane's actual numbers here. We say, Jane, how much were you making in Social Security as income? Because you're only making 20,000 now. And she goes, well, last year I took a sabbatical from my job. Let's say I worked at Charles Schwab, and they give you a sabbatical every now and again. So when I came back from a sabbatical, I'm only working part-time for the time being. Next year I'll go back to full throttle salary. So my income in that regard is only 20,000 for the year. Oh, so let's take a look at your previous earnings. So you've been averaging about 40 or 50,000 a year in previous earnings, have you? Yeah, that's right, Josh. Oh, well, that changes everything, because if we look at our calculator, this takes in consideration all of our income going back to every single year you worked, and we inflate it with a socialsecurity.gov inflator. So in the year 1983, you made $15,000 when you graduated college. That has a 3.19 times inflator, which means your $15,000 gives you the equivalent of $47,000 a year. And then I see that you made $1,000 each and every year more. So every year you got a $1,000 raise. Until this last year when you weren't making much money. So let's just put this in here for 20,000 a year. All right. So what does that do to our numbers? Oh, it doesn't do anything in terms of our numbers. The 20,000 a year is what we have you making. And even with that, unfortunately, because you put the simple estimate in the Social Security calendar, it calculates your AIME, your average index monthly earnings, wrong. Your actual AIME is 1820. And this is why it's so important to go on to socialsecurity.com and get your actual earnings estimates and your previous earnings estimates, because if you're just using your number that for you have today, it's incorrect. And so now what we got to do, go back, is we got to say Jane's actual Social Security numbers at her PIA is 1820, not 1666. That might not seem like much, but trust me, my friends, it is. So we're going to go back in here, and we're not going to use simple estimate. We're going to use on a full retirement age at 1820. All right. And let's see what this looks like now. That's all we've done. Now we're going to go back and do the same for Bob. Now, Bob's got him at 80, is taking at 80,000 a year. Turns out Bob didn't really make $80,000 a year for most of his career. He actually made about 60,000 a year, roughly. So in Bob's case, in 1983, when Jane was making 15,000, Bob was actually making 25,000. And just like Jane, though, he did get a $1,000 a year increase in his salary. And what we'll see here is that in Bob's last year, $80,000. So I'll show you what I'm talking about here, 5496. Let's go here. And we're going to say 5496. We're going to type this in here, 5496. So his Social Security amount is 2261. All right, 2261 is what his amount is. And that is different than what we're showing on on what we're showing for him in terms of his Social Security, because they're using a simple estimate based on when he was making 80,000, but he wasn't really making 80,000. He's making 60,000 a year on average. He just got a promotion for this last year, and he's like, "Look, I'm not going to stay there long enough to really make that promotion kick in for over more than just a couple of years." So what we're going to do is we're going to base on full retirement benefit based on what his Social Security was saying. And it was, what did I say, 2261? Is that what we said? Over here, 2261. So we're going to use 2261 based on his full retirement age. All right. So let's see what that does for us in terms of retirement goals. So we change Bob and Jane's Social Security around to be more reflective of their true amounts, and that changes to 23%. So let's pause right here, because there's other little strategies we can do to make this really work for them so they don't get depressed thinking they got to work until they're 70. We'll take a break right now. We'll come back. So stay tuned, and don't forget to log in or to subscribe to the Heritage Wealth Planning YouTube channel. Thanks, guys.